Hey guys, what is going on? Welcome back to my Robinhood portfolio. What I thought I'd do today is talk about averaging down. A lot of you guys have been asking what that means and also what I do if a stock that I own drops. So I thought I'd just quickly talk about a strategy I employ for stocks that I think are very good long-term plays but are dropping. And that kind of highlights some of the caveats behind this strategy. You do not want to be using this strategy for stocks that are not well-established companies, that are not large cap, blue chip, high dividend yielding companies. You don't want to be doing this for a new startup company, a company that's relatively new, like a Facebook or an IPO for Snapchat is coming up, something like that. You want to do this more for an IBM, for a Pfizer, for an Abbott Laboratories, for some of the stocks that I'm going to be presenting here. So one of the stocks I've employed this for, and actually over a whole category of stocks I've employed this for, are my pharmaceutical stocks. And somewhat of a contrarian method. When stocks are down, you want to buy a little bit more of the stock, and then when the stock increases, you have a little bit better rate of return. So AbbVie here, pharmaceutical stock, $60.42. When I initially bought this stock on the bottom here, you can see I jumped in for a price of $65.04, but you can see my average price up top here is $60.99. So I employed this strategy with great success on this particular company to bring my average cost down to pretty much what it's trading at now. And I might even jump into more of the stock moving forward. Or I know I will jump into more of the stock moving forward. I think this is a great long-term buy. This is the stock that I'm going to be employing in a buy and hold strategy. You can see initially I jumped in when it was very high. Then it started coming down, $64.04, bought a few more shares there. Then I made a big purchase here at $60.08. Again, that's almost, you can see here, $5 less than what I initially bought the stock for. And you can see my average went down accordingly. And then did a little bit of a limit sell there, and then I bought back again at $60.89. So you can see there, on this particular stock, made a little bit of a swing trade, and I averaged down. So not a bad way of picking up additional shares of the company at a much cheaper price. I also did that strategy for Pfizer here. This is one of my first purchases on Robinhood, and unfortunately I jumped in right about here when the stock was $37. So you can kind of see it spiked up there. Unfortunately I jumped in at that point, and then it started trending down after that. So I decided to go ahead and start averaging down. So as the stock dropped, I continue to buy more and more shares of this stock, and at one point here you can see it's down to 23.30 or so. Would have been a great time to pick up additional shares of this company. I think this is a great long-term play. This is a large cap, blue chip, high dividend yielding company. It's all the characteristics of a great company moving forward. You can see on the bottom here, initial buy. You can see, again, jumped in at kind of the wrong time there at $37. And then I made some additional purchases, trying to average down, like I said. So $31.95, I jumped in for some more shares of the stock. $30.96, and then the last one I made was $31.15. And currently the price is $32.27. So I might even jump in to buy a few more shares. Again, like the last company, I'm pretty much sure I'm going to jump in at some point to buy more shares. Third company, Abbott Laboratories here. This is also in the pharmaceutical industry. This is a healthcare company, not necessarily pharmaceuticals. It's actually, this company here, AbbVie Incorporated, was actually the pharmaceutical component of a much larger Abbott Laboratories that kind of split off. So the healthcare portion stayed here, and the pharmaceutical portion went to AbbVie. This is another great long-term buy. Again, a blue chip, high cap, high dividend yielding company here. And you can see, again, for this particular stock, jumped in at 45. And then I started averaging down after that. 42.24, bought some more shares of the stock. 39.15. Last purchase here I made was 38.72. And you can see the price of the stock now is sitting at 42.74. So wish I would have jumped in with a few more shares when it was down in this area here. It's actually at one point down to 37.66 or so. So again, a great stock. The average cost is $39.20, much lower than my initial purchase price. And that's essentially how you average down. You take a stock that you think is a great long-term buy, even though it may be trending down in the short term. That just means it's a great time to pick up additional shares of the company, and you can magnify your returns moving forward. So again, for this company here, if you take the 1-year graph, this is a perfect example. So let's say you jump in here, you can start averaging down in this area here. As soon as it starts jumping up again, you stop buying. When it starts moving down, you buy again. And you can get even more sophisticated by, for example, if you jumped in here at this particular price point, when it got up here, you can sell half of your shares. When it jumped down, you buy, basically double of what you sold. When you jump up again, you sell half of what you just bought. Again, you buy double what you sold. And you can kind of do that moving forward. That's another way of magnifying your returns. Buying the dip, selling the rally. But averaging down, like I said, is a great way of getting into a stock, a long-term stock, and averaging down the cost. So over the long term, you have a much higher rate of return. So I hope that makes sense. Again, this strategy is not for every stock. This strategy is only for long-term plays. Like I was mentioning before, some stocks that may be good short-term plays like a Facebook or Google or something of that nature, that would be fine. And you can even argue Google would be a great long-term buy. But for me, I like dividend companies, high dividend yielding companies, 3 to 6%, that are blue chip and well-established companies, as well as large cap companies, well-established companies, leaders in their particular market sector. So yeah, I just wanted to talk quickly about averaging down here. That's how I've been using the strategy. When stocks I own that I think are good long-term plays start trending down, I start buying more of the stock. I don't start panicking and selling off. That would be the absolute worst thing you'd want to do for a particular stock. So yeah, let me know if you guys have employed averaging down with great success. I have, and I'll continue doing that strategy moving forward. So yeah, let me know how you guys are doing with your portfolios. My portfolio has been doing pretty good, actually, over the last few months. Hopefully that continues moving forward. Yeah, so kind of with that, I'll end the video. As always, if you enjoy my videos, feel free to like, share, and subscribe. I love putting out these videos. I'm learning a ton. I hope you guys are learning as well, following along. And until next video, we'll see you then.